We've been talking about discovery, and some short sellers that definitely caught short. So I've written down some comments you guys gave me from the video we just did, and it looks like we should be taking advantage of some opportunities here. So I'm going to go ahead and take a look at some possible trades we can do. I've already put some on. We'll see what we can do with this. Okay, so the first step here is I've went ahead and offered some puts. So how do we sell puts? So I want to show you how we go about doing it. Right now I'm looking at Discovery A, Discovery Inc. A shares. Okay, so that's what I'm looking at right now. And what we see is something interesting here. So here's Discovery A shares, and here are Discovery B shares. Now go back to the previous video if you don't know what's going on here, because we just talked about this earlier today. This is the spread, which a few people brought up. This is the spread between the A and C shares, which is using the symbol K instead of C, and then the A and B shares. So what you can see is for the longest time there's been a slight discount against A, and for the longest time a slight discount between A and B. So here we see this big spike. So I'll zoom in for you. You see this big spike up here and see this volume? So somebody might be arbing the A and the B. They're not arbing the A and the C. So when we look at this, we're going, okay, could the A and the C shares have a similar squeeze? And, it might be possible, but we got to think about what kind of strategies we might want to use given what we know right now. So what I've decided is that with the B shares spiking up, there's probably some pressure on the A shares to sell down to unwind the spreads is what I suspect. Take this one out and show you. Right now I got an order in here at 9. Let me just take that out and show you what I did. Okay. So you've got to try to figure out what's the value of this 50 put in May. Now we can see the implied volatility here, but what else do we know about this? I decided I want to sell a 50 put, which means I'll be bullish, I'll be long, which means I'm willing to own the shares at $50, but I get to keep the premium. So if I can sell it for 9, that means I'm buying shares at 41. So how do I know when the spread is 850, 890, what's a fair price? So I'll move over to the calls. And you see the spread's only 20 cents versus 40. The calls, look at the volume. 1,300 contracts have traded. How many puts? 15. So all the volume is in the call. So the last traded price is 285 and it's actively trading. So it's just less than $3. So where's the stock at 44? 50 from 44 is 6. So that's the difference. Plus this is trading at almost 3 minus 15. So it'd be 9 minus 15. So this should be trading at 885. It's last traded 882. Now I've already gone in and put an offer at 890, which you can see here, and I was filled already. So I'm actually already making money in this. But let me go back in and put my offer in. If it goes up a little bit higher, I still want to sell more puts if I can. The bid's 850, but I know it's at 885. But this is what we do. If you want to be a liquidity provider, pick your spot and leave your order. So I'm going to leave an order to sell this at 9, okay? And now my order's going in, and I'm on the offer. So here's the bid and the ask. So I'm willing to wait. See, you don't have to do market orders. You can let the market come to you. Now, in order for me to get filled, the stock needs to go down. Now, you'll say to me, why would you sell a put if it's going down? And the reason is because the markets are still random. We still don't know where the market's going. Okay, so we want to be a liquidity provider. When it drops, we want to get long. When it goes up, we want to sell. So that's the basic concept. I'm selling a put, which is like buying a call, except I have unlimited risk to the downside, which means at $9, I'm willing to own shares at $41. So we just talked about how we could sell a put. There's different classes of shares, and two of them have calls and puts, the A and the C. The B, which is being squeezed, the B shares have no options, right? So this one that's going through the roof is very illiquid and has no options. It's flying up, right? So here's the thing is we could buy options or sell options in either the A or the C shares. The question is, which one is the better one to do it in? And that's always the riddle. Capital. So if you look at the 50 puts, my return on capital is about 100%. So normally when I'm shorting puts, I'm either willing to own shares or I'm looking at how much return I can get on my capital. I'm going to watch that and wait and see how it behaves. But as that approaches zero, when you sell a put, when it approaches zero, your risk goes up, your return goes down. So you got to weigh those, like how much more risk do I want to accept and how much am I being compensated for it? So if you think like a banker, you're loaning money out and then you're going to wait to see what kind of return you can get on that money. But as it approaches zero, that risk goes up, right? Risk goes up and your value of the puts goes down. At some point, you want to liquidate that and roll it into something else if you're thinking like a banker. Okay, do you sell the put straight up or have you considered selling the put as a spread? Okay, first of all, Get Gooder is saying, should I still buy DISCB? Should I buy the B shares? No, I don't think you would go in and buy the B shares. I mean, that's just gambling. This is being squeezed. So let's go take a look and see what it's doing right now. Let's maximize the screen. This is being squeezed. If we go on a minute, 5-minute basis, you can see what's happening in here. Okay, the volume came in, hit 150. Okay, we don't know how much further the squeeze goes. So there's huge risk in this. So just now we talked about selling a put and the risk of it. Now, how high do you think it'll go? No one knows where these things can go. Okay, I've been trading for over 40 years. I don't know where they're going. No one knows. Okay, so let's look at these questions being raised. Right. So the one question around would I hold the put till expiry? The answer is usually no. When it gets near zero, I'll unwind it. The other question is, are we still unwinding from busted hedge funds? No, I don't think so. Brokers don't hang on to positions. They're gone. Now, will other ones be liquidated? Maybe. Depends on the pressure from what's happening with all of the brokers with their margin requirements. So that one we think it should be over with, that one. So what other questions? In other words, if we sell the 50 put and buy the 45 put as a spread, the most you can lose is $1.60 and the most you can win is $3.40. Okay, so now David's asking about put spreads. So yes, an alternative to selling a naked put is a debit spread or credit spread. So he's gonna sell the 50 put and buy the 45 put. So then you limit your risk, and then your profits will be less. So in this case, if the spread left you with $1.60, then yeah, in that case you would be risking $1.60 to make $3.40. The most you can make is $3.40. So that's a way to limit your risk or to reduce your size, which is always a good thing to do. So you can either sell a put naked or you could sell a put and buy another put. Sell the 50 put and buy the 45 put. So that's the alternative to taking on greater risk. But there's no free lunch, right? There's no free lunch. So if you do a credit put spread, your return is lower, right? You won't make as much money, but your risk will be considerably less, right? But in order for you to get paid on that spread, the stock's got to trade above 45, right? Whereas when I sell a naked put, I'll make profit if the stock just stays where it is. So that's the difference. There's no free lunch. Some of the stuff is complicated, but that's the basic logic behind it. And so that's it. That's all I got for you on this one. This is just to show you how to sell a put in Discovery